Well, good afternoon, investors. Welcome to our first bull sessions of the month of December 2024. My name is Mark Robertson. I am here with my dear friend and magical mathematician who also happens to be a director and a national volunteer, lifetime educator, and just all around raconteur, Ken Kavula.
My introduction takes up half the program anymore, Mark. You
It's
don't
it,
have to do that much,
it's
okay?
it's sort of like a huge heavyweight fight or something. And
He's
then,
like a generalissimo with all those campaign badges on, a whole chest.
I'll
all
have
right,
to walk around with medals now, okay?
we'll get you one of those big gold belts.
Okay, just what I
And
need.
that and that that other voice you just heard is Matt Spielman. Good afternoon, Matt from Houston. I trust everything is good in your corner of the world.
Good afternoon. 66 degrees, which has a lot of coats on, but is great for me.
Good stuff. And we're also joined here in the back room by Kim Butcher, our guest damsel and a presenter for tonight's roundtable. Good afternoon, Kim.
Good afternoon, all.
Kim is,
Woke up at 50 degrees in Florida this morning.
yeah, Florida was.
Yeah, it was a little chilly, so I was excited because I could get into some sweatshirts. Every now and again, you like to have a little feel like it's winter. A sweatshirt's good enough for me.
Well, we had a nice last week of November down there with 6 out of 7 days being spectacular sunsets and a good time on the beach. So we're grateful for your hospitality. All right, we are going to talk a little bit about a strong November performance, which finished out here a few days ago, a little bit about Tin Cup and describe where that's at. Talk a little bit about Sweet 16 and things in general. We do have a hard stop at 2:45 today. So, Ken, I propose we roll.
Let's do it.
All right. Quick look at Portillo's. Still not cooperating completely, but thought you guys might all enjoy that it was featured as one of the best of the 10 best restaurant stocks to own or to buy right now. You can go deeper at that link on the lower left. And we'll just keep hoping that they will not try to expand too fast and continue to do operationally well. This is your weekly reminder that although they should be, they are not a sponsor of this session. Speaking of disclaimers, here's the overall disclaimer that no investment recommendation is intended by what we do here. It's entirely an educational demonstration intended to demonstrate the philosophies and techniques and methods of the Modern Investment Club movement that you will discover as a member of either the National Association of Investors, Better Investing, or Manifest Investing. Anything you hear here may be an opinion from us. If we happen to own something, we will try to remember to disclose it. But any decision you make is your own. Please do your own homework and be careful out there. We do have a roundtable tonight, so we will be keeping this relatively truncated. Our 2 email addresses are down at the bottom of the page if you have suggestions for topics, questions, or if you'd like copies of the slides. Anything else, Ken?
I think we're in good shape. Keep on moving here.
All right, I had to share this one. Somebody sent this to me while I was on vacation. Apparently, the Cambridge selected their dictionary word of the year, and it came up manifest. So I suppose we should be honored. And then where there was a bit of a debate that, should we really associate with some of the connotations and stuff? And I think if you draw the distinction between manifest and the thing that's been kind of infamous over the last year, this manifesting, I think we're all right. I do think that the visualization aspect of what we do applies, but I do fully endorse. Matt said, well, Matt, you were concerned that it just was that you could basically imagine and make something come true by imagining it. Or
Yeah, here we've all been working hard. We just needed to imagine more. If only Ken had imagined, what was it, CDO or whatever the stock going up 50% in a day, he would have bought more. See, believe it.
Well, no, what he should have imagined was calling me this morning to tell me to buy some. I mean,
I did. Well, no, I had to call you last night to make that happen, Mark.
all right, all right. But no, I do think, this goes along with our, Pulitzer Prize photographer down in St. Louis, where we talk about this notion of visualizing and imagining a future. We don't believe that we can make those futures happen just by thinking about them, but by basically tracing a trail of the facts and reasonable expectations. I snuck that word in, reasonable, in there, Ken, to keep you happy.
Thank you.
I do think that it's a pretty decent capture here. So good stuff. So we'll settle for that. Speaking of manifest presentations, this is not manifesting. This is a picture of the stock market over the last 20, almost 25 years. The green bars are the stock market as measured by the value line arithmetic average. Again, that's basically an average price level of the companies in the value line standard edition. And you can see that the two forecasts, which are on your screen, kind of the orangey or golden versus the red, they do tend to track with each other, and they're both at roughly an 8% annualized expectation. You can see that the last bar on the right has erupted above the long-term trend line, thanks to a very strong November, that November rain we were talking about. And there's a lot of expectations that the month will close out fairly strong for the year. And let's hope they're right about that. Maybe
Now,
if we
Mark,
all...
is the light green bar talking about November, or is that light green bar December now?
Well, that is October and November. So
Okay.
it's a
All
quarter.
right.
Those are quarters.
Ah, that's
Quarterly
right.
bars.
They're quarterly. They're not monthly. Okay.
So we have 30 days to lock that in.
Did you catch that Socratic method in there, Mark, at all? Okay.
I catch a lot of Socrates in dealing with
Okay,
you.
good.
I appreciate that. It's a good thing. But one of the things we do like to point out is, things are getting a little bit tougher to find opportunity. That return forecast on the far right, down around 8%, is as low as it's been since COVID. So it's a little tougher to find stocks to buy, but there's still stocks to study. They're still out there. All right, pressing on. Quick look at the groundhog. No major changes here. Jim Gallagher is still number one, and he's survived a price dip in his number one satellite stock, and one of his companies actually went out of business and went bankrupt, and he's still doing pretty well. Pretty good list. Only problem I have with the list is I'm not on it, although I've been doing better. And the average groundhog checks in at about 21, 22%. It's up strongly over the last couple of weeks. And we are 2 months away from the end of the contest, so that Wizard of Oz sands in the hourglass. Just as a reminder that there's about 2 months left. Your thoughts, Ken?
Well, I have noticed, Mark, that we've lost some of our club strength. We were up to 14 clubs on the list. We're down to 10 right now, with one of them just hanging on by their fingernails at number 40 down there. So it's interesting that the club choices didn't have as much staying power on the top 40 as we would have hoped. I do know Bauer City, though, is holding firm at 5, and they still have 2 months to make a run at it. Although Cowtown has moved really, really close to them now. $5,000 is nothing in this contest, so we'll have to wait and see.
Well, I blame that on Matt and the Texas Revolution down there. Texas has taken over.
Yeah,
Mark,
it's not the only Texas team to move to number 2.
Mark, am I thinking that this is the first time in maybe 2 or 3 months that Jim's lead has been cut into at less than $1 million now?
Yeah, I think Keith has made a pretty good run, and then he dipped down to about 2.4 at one point. So he lost more in one day when that ASTS went down he lost more than the value of most of the ground hog portfolios in
Now, we don't want to
day.
hear that.
And he's still number one. Good, clean fund. Sean Mace checking in at 27. Kim is our representative amongst the Knights of the Round Table, our guest damsel there at 39. So, Kim, hang in there.
I'm
up the
holding on by
banner.
my finger.
Good stuff. All right. The one comment I would make, anytime Kathy Wood is doing better, that's probably a sign that investment clubs are going to do worse, because she tends to do better in weird markets. You know, at least that's what we've observed over the last couple of years. All right. All right, here's our performance perspectives. Again, a reminder that the Investing Roundtable is tonight, checking in at a relative return of 4.1. That's a absolute annualized return of 17.1 versus the benchmark at 13 since 2010. So we've got about 14 years going on that, and that will happen tonight. And again, this is just for some perspective that it is possible to come together as investors and indulge in some of those companies on the list. The 10 company names here are the 10 most widely followed companies and stocks by Manifest Investing subscribers. So it is possible to own them. Many of us own several of those companies. I'm not going to do a roll call, but I think Ken owns at least 7 or 8 of them. But good stuff from top to bottom. And of course, Buttonwood is just getting launched, so no worries about that yet. All right, here's a quick look at, this is just a quick reminder that Value Line does do a presentation on YouTube. It's a monthly presentation called One Stock to Buy Right Now. If you go to YouTube and you just search on Value Line and one stock, you will find those YouTube presentations. And this is just a roster of those selections going all the way back to August 2022. We've covered this at Bull Sessions in the past, but this is just a rundown. Cintas is a kind of a mini community favorite over the years, and it's interesting to see them show up on the list. And the ones that are highlighted in yellow, I have basically closed out the positions. This is not a Value Line thing. I just didn't want to manage too many companies on this version of the spreadsheet, and basically closing them out anytime the relative strength index tops 80. And that oftentimes is in their best interest, would be my experience. What are your thoughts, Ken?
Well, I like the list. And Mark, for the very first time ever, I went and viewed the YouTube on Cintas. They do a really, really nice job of presenting a stock and giving you good reasons, a nice balanced set of reasons why you might want to take a look at it, and what some of the warts might be as well. So it's not a whitewash by any means. It's not a company presentation. It's a very informed, fairly impartial presentation on a fairly decent looking company. I mean, come on, it's a 99.1 quality rating, so we know that it has a lot going for it already. I think Cintas is a very interesting company after watching this, I put it on one of my longer lists to keep an eye on.
Yeah, and I do think if the price were to relax a little bit and fundamentals improve, it could get considerably even more interesting. One of the things that Ken and I were talking about before we came online, we did notice that in the early days of this list, they did struggle a little bit with some of their performance results. And if you look at the growth forecasts of the companies at the bottom, about halfway through this list, we did a session here at Bull Sessions where we basically hoped, perhaps we were even manifesting that we hoped that that Value Line would pick some higher growth rate companies. Lo and behold, look at some of those growth rates on the top half of the list, and some of those numbers are a little more green these days. So again, 16.4 since August 2022, nothing to sneeze at. So it can be a pretty interesting source of ideas. They do think like we do. So it's a valid source of ideas. Notice that NICE, third from the top, is a company that has been presented a number of times at the round table. There's a number of companies on here that have been presented at the round table fairly recently.
I think it's good to drive home too, Mark, that you can turn a return of 16 plus percentage points and still strike out more often than you make a hit. I mean, if you discount the reds and the greens in the final column there in the relative return column, you know, you're striking out a reasonable amount of times. Even the reds and the greens in the annualized total return column are giving you a fairly large number of misses in a list that, oh, frankly, it's very professionally put together, and you would expect maybe they wouldn't have some of these ones that are in double-digit losses.
Yeah, there's a little more volatility there than I would have expected, but that's what makes a market, I guess.
Yep.
So we'll keep watching it. Those are some pretty good companies on that list. All right, here's our quick reminder as to why, you know, on this previous slide, we'd mentioned we wanted to see more growth, and they do seem to be picking companies with a slightly higher growth expectation here lately. This is just that monthly reminder that we find hard to ignore, that these are the top 20 funds, whether they're ETFs or traditional mutual funds, going back over the past 10 years for the most part, 10-year trailing performance. And you can see that it ain't easy to beat the market by 5%, as there's only, 11 out of the 650 funds in the database that have beaten the market by 5%. And they trail off pretty quickly from what you see on the screen. Again, the thing to look at is some of these best students in the class, so to speak. Most of them have pretty decent growth rates. It's one of the driving forces behind us wanting to see 12, 14, or 15% from the Buttonwood portfolio and others. Any other thoughts here, sir?
Well, this is a great list to focus on, Mark, and to keep reminding people that everything starts with sales. When you do a stock selection guide, you have to ask yourself about the sales. And I know the arithmetic from the sales growth number doesn't really factor into an analysis in a lot of ways, but it should be the underpinning of what's going on when you're doing your analysis. The sales should drive where you're going to move with the earnings growth, and from there on, we've decided that it has to be a little bit more robust than maybe it had to be 40 years ago when there were significant dividends being paid.
Yeah, and the other thing that we do like to hammer home is that we consider this list to be a source of ideas. You actually can drill into these portfolios, look for new additions to the portfolios, and perhaps pick up an idea. And we do that quite frequently. Oberwise Microcap at number 15 was the source of a couple of our best small company ideas this year. So it's just one example of what we think is the best practice. All right, here's a quick reminder that years like we're currently having aren't as rare as sometimes we think they are. And this is from Ben Carlson over at Ritholtz. And the one thing that I found kind of interesting is they've been more rare lately. Right side of the chart, right? And if you look, there are some pretty good clusters there in the 80s, early 90s, and then back during the 1950s. So I just found that to be kind of interesting, and it actually dovetailed with a chart that showed up on the forum this past week of, you know, the results from any one calendar year. These are value line arithmetic average results going back to, and I refuse to go back more than 1942. So from 1942 on, and Keith Adamski actually was the one on the forum that got the answer to the question. The green ones are years following a negative year. So again, the preponderance of the green bars on the right-hand side of the chart should give us great hope for that next time, knock on wood, we have a negative year. And of course, Ken, that 1958 is a very special year.
Absolutely. Absolutely it is.
couple of us happen to have been created in that year, so it's a good time frame. Just a good reminder. Anything else you'd like to share here? This is one of your favorite charts.
Well,
So you're just
I
waiting for
like
the
this
next one.
chart. This is individual years, but I really like the chart when we move into 3-year trailing numbers or even 5-year trailing numbers. The bars all tend to move to the right. The numbers that are negative tend to disappear, and I think those are extremely powerful charts. And maybe in the next couple of bull sessions we'll bring up a 3-year trailing or a 5-year trailing. I'm also asking myself, would it be useful to have a yellow dot maybe in the boxes that are following a 30% year, just to see what happens, you know?
Yeah, we could do something like that. Maybe we'll wait for the calendar year to roll
To
over
close,
and
yeah,
take a closer look.
wouldn't be hard to do with the graphics we have available, right?
Absolutely. All right, here's one news item from being on vacation last week. Apparently, we can now trade any time of the day, although it's really a 23-hour stock market as I understand it, and there is possibly one day off, but pretty much around the clock trading. Do you like this? What's your opinion?
I tend to be with the blue. Well, you know, I don't know if I have a real strong opinion anyway, Mark. I do think that it's just the evolution of what machinery and electronics has made us able to do. So that's the blue wedge of the pie, that it's the next evolution. But I also have a strong feeling that that gold piece of the pie is somehow going to have a lot of truth written behind it. So.
Yeah, they tend to do that. I guess my reaction to that is they were already seem to be doing some of that with the thin amounts of trading, after hours and pre-market. But Kim, what's your opinion?
Well, I just think that people who are not knowledgeable are going to think 24/7, oh my goodness, I can open up the computer and I can do this and I can do this, and if people aren't educated, there'll be more losses.
Yeah, fair enough. How about you, Matt? Do you have an opinion on which of the slices best describes how you feel about it?
Long term, I think it's good. I share, after hours trading can be Wild West. I've been watching in my own portfolio over the last few months some wild swings that last for just a minute, essentially a single trade. But I think it is an anachronism that it's a specific time of day. There are a lot of other financial transactions that already can happen at those times. When I was living in Ireland, I would have appreciated this, just so I didn't have to stop. Just so I didn't have to stop in my work day to be at the start or something like that. So I do think it'll be dangerous for a while. It'll be interesting to see if institutional trades sort of get used to this and work around the clock. So that could be quite interesting.
I do think it actually addresses some of the rhino and whale issues with after hours trading. And I do think I agree with all of you. I think it's a bit of a casino potential, especially early on, for those who like that sort of thing. I mean, I was sitting watching people watch a football game the other day, and they were betting on things like, will there be a fumble during the next offensive series, on FanDuel or the stuff that they're doing, and that's different for me too. But I think it is just part of evolution. And hey, as I told many of you when I tinkered with Ethereum cryptocurrency just so I would understand it a little bit better. I did have trouble getting used to the fact that is around the clock. If you didn't know that, Bitcoin and the cryptocurrencies do trade around the clock, for years now. And that was a little tougher to get used to. It's like you don't have that closing bell time off period, from that sort of thing.
It's kind of hard to walk away from something if it's on 24/7.
Yeah.
I'd also like to see more than 296 responses before I formed an opinion on where the mob was on the whole thing. And Patricia has made the comment that maybe that blue dot would be more representative if we could take the word amazing off of it and just say it's the next evolution of financial markets. And I agree with her wholeheartedly
Yeah,
that I don't want to say it's necessarily amazing, but I do think it's the next evolution.
fair enough. All right, keeping crunching. Here's another one that I'm not sure how. I really don't know what to think about this because I've been a serious investor since the late 1980s, early 1990s, and at no time during my investing experience have has it made sense to do some of that global balancing. Um, are we approaching that point? What is your, maybe we come back to this and take a closer look, but what's your general impression?
Well, Mark, when I first started investing, some of the gurus that I was listening to told me that I had to have an exposure outside of the country. And I went into two mutual funds that were supposedly going to give me some exposure to emerging markets and to established markets outside of the US. And to be honest, neither of those two really highly regarded mutual funds have done anything like I could have done on my own in creating portfolios that were put together of basically US stocks. And I've come to the conclusion, as far as my own investing is concerned, that I don't need something specifically aimed outside the country, as long as I have enough of these large multinationals that are US based in my
Yeah,
portfolio, with an occasional glance at a company that might reside in Ireland or Israel or Brazil or somewhere else. I'm not opposed to putting a foreign-based stock into my portfolio, but I'm no longer looking for a mutual fund to fill in a gap or a perceived gap in my portfolio.
well, we have talked about this before, that efficient frontier graph that used to be so popular. You can't even find it anymore. And that was to
Right.
promote international diversification. The one area that I think might be kind of interesting to look at, you may recall when Ty Hughes did the thrift savings plan for the government. They have an I fund, an international fund, and we basically ripped it to shreds, and said that it has not really delivered, much like what you just said, Ken. And I just
Yeah.
wonder if maybe the outlook on that particular fund in the TSP plan, you might recharacterize that a little bit, but I think it's something we come back to. I'm with you. I've heard the advice for a couple of decades about international diversification, and it's just never really, really come to
Well,
pass.
I have the numbers to prove that it doesn't really it hasn't given me a lot of return. And I invested in two really high quality funds. One was, at the time, it was run by the Acorn mutual fund conglomerate. It's been bought a couple of different times. It's no longer Acorn, but it still carries the name Acorn. And the other one was a Harbor fund, and
Those are both
Harbor
great funds.
was a really established international fund, that
Mhm.
had a very, very good reputation, but neither has performed it anywhere near even the S&P, let alone beating the S&P.
Yeah, and even the Templeton, driving by the Franklin Templeton building this week, I mean, even the Templeton International has not had that strong a performance relative to other stuff. So again, it's a head scratching moment. I think we'll probably come back to this in some shape or form. So it's just out there. Quick,
I would, my comment on that is, it wasn't, usually the pitch is not that emerging markets or other places outperform in gross terms, except for short-term periods. It's that they're non-correlated. If you look at the return of the U.S. market
Right.
since 2010, non-correlated means probably not too good. Otherwise, they would have been highly correlated.
Yeah, it's that correlation thing and balancing and traditional asset allocation, which I just won't say anything about that for right now. But this is mathematically, this is significant. I mean, we're talking multiple standard deviations outside of a normal range, so it is statistically significant.
Well, and Mark, I can give you an anecdote that maybe doesn't mean anything, but during a certain point in our life, we had a lot of exchange students, and we still keep in contact with most of them. And those exchange students used to be very interested in my investing career and the journey that I took from the beginning to where I am now. And they became investors when they went back to their home countries. And most of their portfolios have devolved into holding a majority of U.S. stocks now. They don't hold a lot of stocks basically from their own countries. Now, these were except for two Japanese boys, these were basically Europeans. But at the same time, the anecdote says that maybe people aren't in as love with their own stock market as they are with some of the things that are happening in our stock market.
Well, maybe it's time to send a couple Chinese students to your house and see what.
We're past that now, Mark. Okay.
Moving on from there. Okay. Quick look at Buttonwood. We'll be taking a closer look at Buttonwood next week, but just wanted to give everybody the update along with the Luminar stock split. And the portfolio's in pretty good shape. I note that the growth rate is right where we want it to be, even maybe a little bit higher. Overall par is pretty good too. Some of you have written and asked about this indicator, so let's talk about that. I actually had an alert set on Novo, and you can actually set a variety of alerts on your portfolio holdings from your dashboards by simply going to the company and setting your own alerts. And in this case, I wanted to know if Novo actually got up to 15%, which it recently did. It actually entered the sweet spot, set off the alarm. I got an email. Second time that's happened in my life, so I added some shares of Novo to personal portfolios. And you can see that I also want to be notified if Apple drops below a par of 1%, just so I know that it's happening. So it's just two examples. So you can actually set them and have some fun with them.
Mark, give us the ENTSS. What does that mean? You had set to true. What's that stand for?
Entering sweet spot, exiting sweet spot.
Okay.
Then
Got it.
Quality less than or greater than the projected annual return, financial strength, obviously growth rate. If it sinks below a certain level, might want to be notified, and that's earnings per share stability. The one that I'm going to have Kurt make an adjustment is we do have alert triggers on relative strength index also. So that I'd like to see that one displayed on here. It's on RSI, yes.
And that growth is sales growth, Mark, right, Mark?
That is sales growth.
Okay.
So that's there. That's what triggered that. Here's a quick moment with Tin Cup. Just wanted to celebrate the fact that we have reached an all-time high. In fact, on my Yahoo portfolio, it's actually close to 4.9 million today. So at 4.8 million, this long-running demonstration, which will be 30 years old in a month, again meant to demonstrate what if you had put the maximum amount in a 401k for the last 30 years, basically investing like Warren Schloss, George Nicholson, and the Modern Investment Club movement. What might you have been able to do? You're looking at it. Here is the Tin Cup portfolio in the most recent month. Now, we did sell Air Lease because it had one of the lower return forecasts. I still think it's a great company. Again, this is portfolio specific. So Matt, not meant to insult you or anything else, although I did notice you had paired your holdings a tiny bit in Air Lease.
Yeah, I have a written analysis or thoughts in the decisions manifest thread.
Yep, in the forum, so you can read what Matt follows the company very closely. This is just a matter that it's the lowest projected return, and we wanted to boost the overall portfolio return. You can see that we accumulated stocks that are in the sweet spot along the way. So that's just there for everybody to observe. Here's the Sweet 16 for the month. This will be used tonight because, believe it or not, Ken, all four of our companies actually made the top 16. And so 4 of those companies will be presented tonight.
Give us a rundown on what Sweet 16 means, Mark.
Basically, the Sweet 16 in this case is a sort by manifest rank, which is basically taking the projected annual return and the quality ranking, those 2 most important characteristics, adding them together into an index and ranking from best to worst. And these would be the top 16 companies amongst our 20, I think it's about 2,700 companies now. So you're looking
Mark,
at
this
the top
is
16.
10-minute warning.
Oh, this is a 10-minute warning? Thank
10
you.
minutes.
All right. I'm still flipping back and forth between Nice and Mueller Industries, but we'll see between now and 8 o'clock tonight.
I will. I haven't remarked on this, Mark, because I just noticed it, but I've been kind of moving down the proof column and comparing it to the par column, and finding in no case are we significantly varying between the 2 numbers, and I think that's an amazing kind of a thing to have happen on a list like this.
Yeah, it generally suggests that most of the PE ratios, the projected PEs, are pretty reasonable. Sai is going with Gentex tonight. This company continues to annoy me. You saw it on that value line list. Every time I think about buying it and don't, it goes up 100%. So just incredibly annoying company, but good, clean fun, and we will be featuring them.
What company is Kim doing tonight?
Kim is computer modeling at the bottom there.
Okay, and I'm doing Double Verify right above it.
And the source of Kim's idea is Christopher Meyer in that book, 100 Baggers. She's going to talk about that a little bit tonight also.
Kim is going to tell us, however, that we can't buy this one on the American exchanges, right?
She is. I was pleased to hear that it's covered at Better Investing, though. So.
Yes, well, it is. Yeah.
It is covered by Better Investing, and it is on the pink sheets on the American exchange.
So Christopher is fishing in uncharted waters, so we'll look forward to a little more exploring on that.
Charles had words for me when I wanted to know why I couldn't buy it. Okay. Charles, as in Schwab, had words for me. So.
Oh, you actually tried to buy the company?
Yes, I really liked this company about 2 months ago, and I tried to buy a piece of it, and Charles told me I had to pay him money to do it, and I had to go through some shenanigans to make it happen. So
I hate it when Charles misbehaves like that. Good, clean fun. ZTO Express, by the way, is a Chinese company that's tied pretty closely to Alibaba, so I left that one in there just to keep Ken riled. All right. So we are going to cut off a little bit early today. We can stick around and answer a couple of questions. Here is your reminder that we do archive all of these sessions, whether they're bull sessions or roundtables or special sessions like our best small companies over here on the right, on the YouTube channel. If you go to YouTube, Manifest Investing, and search on any of that type of stuff, please subscribe if you'd like to be notified anytime new content is added there. And then again, just a tease for some of the stuff that's coming up, we'll take a closer look at the Buttonwood portfolio next week. Do want to talk about some podcasts there. I was surprised to see that Chris Myers is not on there, but I'm pretty sure he has a podcast. And we will be taking a look at that book on the right at some point in the future. That image on the left, I thought we might spend a moment on. That's the old Quicken one-click screen from Better Investing. This is actually about 20 years old. In fact, it's Orthodontics Centers of America, which I believe they went out of business. But this was a kind of an interesting app that was on before things were called apps. It was an app on Quicken. And I'm just wondering, do you remember this from the back when?
Absolutely, I remember it, Mark, and I think it dates right about the same time that the software was coming out, which we called Toolkit back then. And I think they were all kind of dropping, one after another, and they were all bright, shiny objects, and we were looking at all of them and playing with them.
Yeah, I was personally involved with this in a little bit, talking with people at the Quicken staff, and um, I just thought it might be kind of interesting to dig that out and dig into it a little bit deeper, see what we might do differently or might have done differently, but just throw it out there as a potential thing. One of the more popular presentations that I have given over the years is my 60-second analysis of companies. And it was kind of related to this concept back then. So maybe we'll tinker with that also. Done a few 60-second presentations.
Mark, you mentioned 20 years. Is it a little bit longer than that, actually? I think we should find that out before the next time, because I'm thinking this is closer to 25 or 28 years. Maybe not, though.
Well, I know that the article that I took this from was dated 2001.
Okay.
It was from 2001. And I think this particular app had been out there for a little while. So yeah, it takes you into the late 1990s.
Okay.
So we'll have some fun with that also. And here's my image from our balcony last week. It was easy to have Happy Thanksgiving under these conditions. I do like to include it though, because you might see that little dune that's there just beyond that walkway area. That is hurricane relocated sand. And it's a pretty good sized dune that normally sloped down and away from those stairs. And the hurricane left a fairly impressionable amount of sand in the resort area right off the Gulf. So there you have it.
Know
right.
about it very well.
Yeah, and it was interesting. I was quite pleased that there was not as much damage as I expected. There was plenty of damage, but I think it could have been worse. And as we came to know, the amount of damage actually went down pretty rapidly as you got away from the coastline, as you might expect. All right, Ken, anything in the hopper? I still show we've got 3 minutes if we can use them.
Well, thank you, Matt, for helping out with responding to our audience when needed. And we've just been, I've let you be aware, Mark, of almost all the comments that were germane,
Okay.
and we're in pretty good shape in the back room here. So I just want to say have a great next week. I'm going to spend it down in Florida with some friends, and then we'll be back next Tuesday again.
Okay, and we will have the program tonight. And again, this will be part of the program tonight. 4 of these companies are actually being presented. So with that, we will go ahead and sign off. Take care, everybody.
8 o'clock Eastern time, start time, not 8:30, 8 o'clock. Okay.
Thanks, everybody.
Good night.